What are the top 5 things that affect your interest rate when obtaining a mortgage? Now, truthfully, there are more than 5 things that can affect your interest rate when purchasing a home and obtaining a mortgage, but these 5 are probably the top 5 in terms of you as a borrower having a direct or very close to direct effect on them. Number 1, which is probably the most obvious, is your credit score. Now, your credit score directly affects how high or low your interest rate is, as well as how high or low some of the fees are with your mortgage. Now, credit scores can range quite a bit, but a perfect score is 850. And I can tell you, in my time as being a mortgage loan officer, I'm yet to see an 850 score. Now, I've seen a lot of 840s, 830s, and 820s, but never a perfect score. But nonetheless, the higher your score is, the better your interest rate is going to be on your mortgage. The second one, and this is a little less obvious, is your property type. And what I mean by that is, what kind of property are you purchasing? Are you purchasing a single family home? Are you purchasing a condominium? Are you purchasing a manufactured home? Each property type has an inherent risk associated with it. Condominium projects have an HOA, and that HOA has large responsibilities in that complex. Well, if that HOA is not solvent or it's not doing its job the way that it should, it can cause additional risk to lenders, which can make the interest rate a little bit higher versus if you were purchasing a single family home. Another example of this would be a manufactured home. These homes are built off-site and then placed on the respective property that they're likely going to sit at for the remainder of its lifetime. That can cause risks, as well as the quality of the build, and if there is sewage on that property or septic and many, many other things. But that is another reason why manufactured homes can sometimes have a little bit of a higher interest rate than, say, a regular stick-built single-family home. The third factor, which is a little more obvious, is your down payment. Now, generally speaking, the more money you put down, the lower your interest rate is. That doesn't always work exactly 100%, but let's say it's about 90% of the time. And this goes into the risk that is involved with you as a borrower obtaining a mortgage. If you're putting more money down, that's more skin in the game that you have, and that's a lower mortgage that you will be obtaining as well. This would create lower risk to the lender because of your skin in the game and the less amount that they're putting out in terms of loan to value of the home. So with this lower loan to value, which means you are putting more money down, that is going to be lesser risk. Therefore, the interest rate will look a little more attractive for you as a borrower. Now, number 4 is loan type. Now, as I've discussed in previous videos, there are many different loan types in the marketplace, but the most common ones we hear about are conventional loans, FHA loans, and VA loans. Now, each one of these loans has a little bit of a different interest rate that comes with it. Now, there's a number of reasons as to why, but to look at it simply is there's different governing bodies backing these respective loans, and there's different credit score requirements for these loans, different occupational requirements in terms of VA. One must have been a veteran or have served our country in some capacity. So all of these factor into these respective loan types having different interest rates that come with them. As we sit here today, government loans, FHA and VA loans, generally have a lower interest rate versus conventional loans, which are backed by Fannie Mae and Freddie Mac. So the type of loan that you obtain can also absolutely change the interest rate that you get with it. And lastly, number 5, I'm going to lump in 2 factors: loan amount as well as loan term. And what I mean by loan term is your loan a 30-year fixed, 20-year fixed, or 15-year fixed? Generally speaking, the longer your loan term, the higher your rate. And once again, this goes back to risk. If your loan term is for 30 years, that's a longer period of time that the lender is going to have its money out in the market. That's riskier for them. Versus if it's, say, a 15-year fixed mortgage, they're expected to get that money back sooner, which is less risk to them. And as I said, I'm pairing this with loan amount. Now, this one kind of seems a little odd, but interestingly, when you have small loan amounts, let's think of buying a home and having a loan amount of $50,000, $80,000, say anything under $100,000, which in today's world is a pretty small mortgage. That is less attractive on the secondary market, meaning investors aren't as attracted in purchasing a loan that's that small because the income they would receive from it is not that much. Versus if they were to purchase a home or a mortgage, with a $500,000 or $1 million loan amount, there's much more money to be made on that. Therefore, it's easier to sell on the secondary market. So with a smaller loan amount, they need to make it a little bit more attractive to the secondary market, which is why that interest rate is higher on a smaller loan amount than versus a larger loan amount. Now, this was a brief overview of these 5 different factors. I certainly could get into greater detail. Maybe I'll make a video that has greater detail about each respective factor. But if you have any questions about any of this, please feel free to reach out. I'm always here to help. And please leave a comment. I'm always happy to comment back.